Welcome to my channel. I'm Dr. Romano. The question today is, why would somebody invest in a funds of funds? A funds of funds is a portfolio of hedge funds, and it may consist of 10 hedge funds or it could be 100 hedge funds. It just depends on the AUM, assets under management. As you know, on YouTube, my name is Dr. Hedge Fund, but my real name is Dr. Romano, and I specialize in hedge fund selection. I completed a PhD on financial management and leadership. However, my research, 1,000 pages of research, scholarly written, was on hedge fund selection and operational due diligence of hedge funds. So, you've come to the right person to talk about hedge funds. You've also come to the right channel if you want to increase your wealth and learn how to keep it. Just because you are capable of making a couple $100,000 a year or a couple million or a couple billion, it does not mean that you are capable of keeping it. The issue happens is where you get people in this world that they're very specialized and very good at what they are, but they're not good at everything, such as myself. I do not know everything. I know what I know, and I believe in what I know, but unfortunately, I'm human. So a funds of funds is the best alternative to invest in hedge funds. My previous video, you would not want to invest directly into a hedge fund because you are not a specialist like I am. And just because you have investment managers at investment banks or other funds of funds that specialize in portfolio management, that doesn't give them the expertise on how to select and deselect a hedge fund for one's portfolio. And that is why the funds of funds industry and selecting the best funds of funds is the most important thing that you could do to gain a return on your investment. Another reason why you would not want to invest in just any type of funds, you have to know the size, the age, etc. And also, another reason why hedge funds have become so lucrative and it's become such the future that everyone wants to invest in a hedge fund. Nobody wants to invest in an investment bank because their traders are terrible at managing risk. This is why after the collapse of '08, you've seen the investment banks pouring billions of dollars of capital directly into hedge funds. But what do they know about deselecting or selecting a hedge fund? That's the question, and that's the argument today in this video. And I want to share with you what I know and what I do. As you could see on YouTube, I provide a lot of market analysis and my predictions on the stock market, the real estate market, the commodities market, the cryptocurrency market, and just overall the status of our economy. This previous 2020 was a remarkable year because it proved how resilient our government is in managing our economy. They pumped a lot of capital into our economy. I don't know if it was really that a lot of capital because what I got and what other people got, it wasn't a lot. However, it changed a lot of situations and it changed our 20-year future period forever. The ideology that you could have your products made in another country and it's cheaper is no longer probable. The fact is, with skyrocketing oil prices and the instability of the global market, including the workforce and the pandemic and the after effect, what the pandemic created, it is now possible to have your products made in America. Before we continue the video, please remember, if you like my content and you want to say thank you, Anthony, please do thumbs up. It's right there. Thank you so much. Part of your investment portfolio should be a funds of funds. I'm not saying take all your capital and dump it in the funds of funds business, but you have to remember that you should have a certain percent in real estate, okay? And you need to protect yourself legally, meaning you do not keep your real estate in your own name. You create an LLC for that real estate, and the owner of that real estate is a private foundation in, let's say, Panama, but Panama copied Liechtenstein. So you're probably better off going to Liechtenstein and creating a private foundation, but depending on how much assets you have, it may be cheaper for you to use the Panama private foundation as opposed to a Liechtenstein private foundation. However, it is much better to just go to the country such as Liechtenstein to have your private foundation completed because it's the real thing. Panama simply copied that. So once you have a certain percent of your assets in real estate, that could be your own house, or it could be an apartment building, collecting rent, etc., then you have to have a solid rock hard investment such as a diamond portfolio or gold, commodities, etc., collect coins such as gold coins, and that section of your portfolio, you never ever sell it. And when I say you never sell it, I mean you never sell it unless, let's say, you're going bankrupt or something really bad is happening. That particular area is more of a cushion because diamonds never ever drop in value. They only go up. And in a stock market collapse, they trade sideways. Secondly, when there is a stock market collapse, commodity prices skyrocket, and that means your gold coin portfolio will also skyrocket. So you're hedging yourself against a collapse. Then a certain percent you want to have it in the stock market, but since you're not a specialist of selecting and deselecting stocks, I honestly recommend that you do not take that responsibility, because you have to understand a lot about market cycles. And when you understand about market cycles, and that's a huge topic to talk about because there's many types of market cycles. We just finished the real estate market cycle of 25 years. Now, all of a sudden, interest rates are going up. Interest rates should have been high for 10, 15 years now because real estate has been going up. So, but now we have a situation with our federal government and their debt. Other countries are threatening us that if we continue to raise our interest rates, they're going to dump their portfolio of the American debt, etc. I don't want to get into that in this video, but I'm going to talk about it in another video. And so hedge funds have become so lucrative, and you have to say, well, why is a hedge fund so lucrative? Why do these hedge fund managers make so much money? Why are some people hating hedge funds? Well, the fact is that you hate hedge funds, then you hate the American dream. The fact is that if you actually learn how to trade and prepare yourself with an understanding of risk management, then you could place trades on the stock market and make money. It just depends if that's your ability and what you have a passion in. Because if you have a passion in trading, you will become successful at trading. You don't need to be a rocket scientist. The fact is that, yes, there's been studies done that either certain people are born with the ability to trade and certain people could be taught how to trade. But what is different is the passion. And if you, as a hedge fund manager, are doing really well, I highly recommend that you focus on what you know. Because part of working for yourself, it triggers something in the brain. And it's not just a responsibility, but it's something even deeper. It's something that you want to learn everything that you have to learn to improve your investment selection process on stocks and investments, etc. And so by you either quitting working for the investment bank and you went on your own to start your own hedge fund, or you just wanted to trade and you started when you were young or when you were older and you have a passion for it. Warren Buffett didn't start his career until late in his life. People didn't take him seriously until late in his life, until he lost some hair. Now, we also have someone with that personality that don't have mental blocks. People who don't have mental blocks, they tend to do better in business. And that's one of the reasons why hedge funds are becoming what they are. Don't look at assets under management to select a hedge fund, because you have to remember that the investment banking industry has been investing in hedge funds heavily. And so it also affected the returns of a hedge fund, because hedge funds got so big that now it's like they can't handle the capital that they have. That's why a funds of funds manager knows to look at those smaller hedge funds, those guys and girls that don't have charisma. The fact is that if you have charisma or not, it actually means nothing. It has nothing to do with success. The word success is someone like Joan Crawford or J.P. Morgan or Napoleon Bonaparte or Adolf Hitler, who, when you say no to, it triggers something in their brain, and they will do everything and anything that they have to do, including learn what they have to do, to become successful. And that's called ambition, momentum to succeed. And you need that momentum to be successful. And that's why the character called Forrest Gump, he didn't have that mental block. Instead of listening to older people around him not to buy Apple, he went and bought Apple. So the funds of funds business produces a smoother return for your portfolio because you have a number of hedge funds trading. And because you have a number of hedge funds that are really, really good at what they do, it has nothing to do with producing a 50 or 150% return in a year. It has to do with being able to manage your risk. And as a hedge fund manager, put it this way, if they have 5 years experience and they've been in business, you could guarantee they could manage their risks. Because if they didn't improve their investment risk management approach, they wouldn't be in business. The investors would pull out of them. And so that's a real track record to look at, because at investment banks, those traders that are trading your retirement portfolio, they either went to an Ivy League school, they were recruited by the actual investment bank, or their daddy or their mommy is a billionaire and that's how they got that job on the trading floor. You have to remember, any job that's highly lucrative, such as a financial trader at an investment bank, those type of jobs are very hard to come by. So you either have to know someone like I knew. I was very lucky to know my best friend that worked there. And I also had another friend that worked at the other investment bank that was also a trader. And how did he get that job? Through his uncle. And I had a cousin that was also, actually my cousin was recruited by an investment bank because he went to an Ivy League school. And my friend that hired me, he also went to an Ivy League school, and his friend as well. And so if you want to say, I don't know what I'm talking about, well, back in those days, that's how it was. Maybe now it's different. But the fact is that just because you go to an Ivy League school, that doesn't mean that you're capable of trading and managing risk. I can tell you right now. You are good with taking a test, and that is a short-term memory that you need to take a test and pass it with 100. A true financial trader has an enormous visual capacity. They also remember their mistakes, and that's long-term memory. So, typically, I'm not saying all, but a really good trader is going to probably do bad at test taking. So what does that mean? It means that they're probably not going to go to an Ivy League school unless you're like my friend's father, who was the dean of a university. That's how he went to an Ivy League school, because his father and mother both went to that school. So in his case, I don't know what his test-taking ability was, but maybe it wasn't good. I don't think he liked school. And I'm sorry if I'm talking about you. But this is how I learn, through people's mistakes and through people's lives and learning about that stuff. I look at every little thing and I analyze it. That's why I'm Dr. Hedge Fund, and that's why I love hedge funds. And I love being part of this community. So that's why the funds of funds business has become what it is today. It is the future to invest directly into hedge funds. And it is also your future, because if you're worth at least $1 million besides your house, you are qualified to be an accredited investor and invest in hedge funds. If you make at least $200,000 to $300,000, I don't know because the laws change, you could also invest in hedge funds. But a lot of people, unfortunately, they may have the capital, but they don't have enough capital. They may not be able to invest in hedge funds. And so I feel very bad for those people who want to make money. 20–30% a year is actually really good. And if you have the right capability to deselect and select a hedge fund, that's all probable. Whereas if you invest your capital in one hedge fund, 200 or 300,000, you're basically creating a big risk. Number one, what if the other fund that you wanted to select was making 40–50% the following year, and the fund that you selected only made 2%? The fact is that most people select a product based on the salesman and not charisma of that person. And so women, they will actually buy the product from the dominant man, and the man will select the product from the man who they trust. You have to understand psychology. So selecting a hedge fund based on the personality of that hedge fund manager is not a way to select a hedge fund. And this is why the public does not know how to select a hedge fund. Just because you look at their returns over a 5-year period or a 10-year period, it doesn't, oh, they have $1 billion in assets under management, it doesn't mean anything. Because right there, you would not want to invest in a hedge fund that has $1 billion of AUM. With $1 billion AUM, it depends on the strategy and the markets they're trading in. It will affect their returns, and they will get watered down returns. This is why big hedge funds such as Steve Cohen, Ray Dalio, Ken Griffin, all those gigantic hedge funds out there, and that's just a few, they need to separate all the traders that they have, allow them to have their own hedge fund with their own LLC, with their own fund, so that they could have the responsibility into their own hands on how to trade, how to improve their trades, how to improve their risk management approach, and allow them to have that responsibility that you get when you are your own business owner, your own boss. I'm not saying only invest in the dominant person. The fact is, the dominant person is the least capable of actually being successful, because the only thing they're good at is actually telling everyone else what to do. And so without everyone else there, they're incapable. And so this is another reason why a hedge fund manager is so amazing. The ability that they've created, they've proven their ability and what they have done. They're not just a dominant person getting the job, right? Because those are the people that become the directors, the vice presidents, the CEOs. Those are the least capable of being a trader. I'm not saying that everyone that's dominant isn't a good trader. There are certain people that are good at trading that are dominant. But I'm saying as an entirety. There are many reasons that I haven't covered in this video. Why is a fund of funds so beneficial for clients? I want to thank you so much for watching my video. Please remember, if you like my channel and you want my future videos, to subscribe so you get them directly. And please remember to do thumbs up if you want to say thank you. It's right there. And then finally, please remember, if you have questions, I will make a video just for you, or I will answer it in the live chat. And finally, if you do have other people that would like my video, please do send it. You could use the button right there called share. Thank you so much.